Hey there, folks. Welcome back to another episode of Inside Nova CRE, where we dive deep into the trends shaping Northern Virginia's commercial real estate market. I'm your host and Brian's AI assistant, filled with genuine insights, here to help you work smarter, not harder. Today, we're exploring cap rate trends from 2023 through early 2025 across Loudoun, Fairfax, Prince William, and Fauquier counties, so grab your coffee and let's get into it. Let's kick things off with Loudoun County. This area has shown remarkable stability, maintaining an average cap rate of 6.3% throughout our study period. Such steadiness suggests a balanced market with sustainable growth potential, a rarity in today's volatile investment landscape. Moving over to Fairfax County, we've observed significant cap rate compression, with rates decreasing from 6.7% in 2023 to 5.9% in 2025. This trend reflects strengthening investor confidence and increasing property values, making Fairfax a hotspot for commercial investments. Prince William County presents an interesting counter-trend. We've seen a modest 20 basis point increase in cap rates from 6.2% to 6.4% over the same period. This slight uptick may indicate marginally higher perceived risk or changing market conditions specific to the area. Lastly, Fauquier County positions itself competitively with a 2025 median cap rate of 6.0%, sitting comfortably between its neighboring counties. Now let's break it down by property types. Office sector with signs of recovery. Despite nationwide challenges, the office sector in Northern Virginia has shown encouraging signs. Regional cap rates have decreased by approximately 49 basis points, from 8.2% in 2023 to 7.71% in 2025. This positions Northern Virginia's office properties with cap rates higher than the national suburban average of 7.34%, but lower than secondary suburban markets at 8.5%, reflecting the region's economic strength and government-adjacent tenant base. Industrial and warehouse are cooling from red hot. The industrial sector shows signs of normalization, with cap rates increasing by 60 basis points from 7.0% to 7.60% between 2023 and 2025. However, extremely low vacancy rates across the region suggest continued strong demand despite this modest adjustment. Interestingly, Northern Virginia industrial cap rates, ranging from 6.21% to 7.6%, remain notably higher than both national 5.27% and East Coast regional averages 5.08%. Retail sector has been surprisingly resilient. Despite e-commerce pressures, the retail sector demonstrates remarkable stability, with only a slight 20 basis point increase in regional cap rates from 6.8% to 7.0%. This resilience is supported by extremely low vacancy rates, just 3.5% in Manassas, and a 3.7% regional average, suggesting strong fundamentals in Northern Virginia's retail corridors. Now, multifamily is still the investment favorite. Multifamily remains the preferred investment class, boasting the lowest cap rates across all property types. The 2023 regional average of 5.8% has likely decreased slightly to around 5.5% in 2025 as the sector continues to benefit from housing shortages and strong rental demand. Several key factors explain the cap rate variations observed across Northern Virginia. 1. Proximity to Washington, D.C. Counties closer to the district generally show lower cap rates, highlighting the premium placed on location. 2. Transportation infrastructure. Access to metro lines and major highways significantly influences investor perception of risk and growth potential. 3. Development density. Established commercial corridors typically command lower cap rates than emerging areas, reflecting investor preference for proven markets. Investment implications for those looking to invest. Buyers, value-oriented investors should consider Prince William and Fauquier counties, where higher initial yields may compensate for slightly elevated risk or less central locations. The office sector, despite showing the highest cap rates, demonstrates improving fundamentals that may present opportunities for investors with longer time horizons. Sellers. Fairfax County property owners are enjoying a strong seller's market with the lowest cap rates in the region, translating to premium pricing opportunities. The retail sector's resilience presents an opportune moment for owners considering disposition, as low vacancy rates and rising rents contradict the national narrative of retail distress. Long-term investors. Loudoun County's consistent cap rates suggest a balanced market with sustainable growth potential, an ideal environment for long-term holders seeking stability. The varying performance across counties and property types highlights the benefits of geographic and sector diversification within Northern Virginia investment portfolios. Conclusion. Northern Virginia's commercial real estate market continues to demonstrate remarkable resilience and nuance. The cap rate trends observed from 2023 to 2025 reveal a market that rewards careful analysis and submarket-specific strategies rather than broad regional generalizations. Investors who understand these geographic and property type variations can identify compelling opportunities across the risk-return spectrum, from the stability of Loudoun County to the value propositions of Prince William and Fauquier counties to the premium positioning of Fairfax County. Oh, and hey, before we wrap things up completely, let's take a quick step back just in case the whole cap rate thing feels a little fuzzy. You're not alone. This is one of those real estate terms that gets tossed around a lot, but rarely explained in plain English. So cap rate, or capitalization rate, is basically the return an investor expects to make on a property based on the income it generates. Think of it like this. If a building earns you $100,000 a year and you bought it for $1 million, that's a 10% cap rate. It's a simple way to measure how hard your money is working for you in a given asset. Now, here's the part that trips people up. When cap rates go up, it usually means property values are going down, or at least people are pricing in more risk. Maybe the market's a little shakier or interest rates are higher, so investors want a bigger return to justify buying. That's when you start hearing phrases like buyer's market. When cap rates go down, on the other hand, that's typically a sign that demand is strong. Investors are confident, the area is growing, and they're willing to accept a lower return in exchange for owning something in a hot location. That's great if you're a seller because it means you can ask more for your property and still attract interest. So yeah, watching those cap rates move is like reading the market's mood. And here in Northern Virginia, they've been giving us a pretty interesting read lately. Some stability, some compression, and some signals worth watching closely. All right, let's wrap up and give a special shout out to Brian Snook, the true host, developer, and creator of InsideNoVACRE.com. For all your Northern Virginia commercial real estate needs, visit InsideNoVACRE.com. You can reach Brian directly at brian@weber-rector.com or give him a call at 703-863-1895. Brian's extensive experience and local insights make him an invaluable resource for investors and businesses alike. That's all for today's episode. Stay tuned for more insights, and remember, at Inside Nova CRE, we're all about working smarter, not harder.